Okay, let's dive straight into this explainer and investigate a truly fascinating paradox in modern finance. Today, we're taking a look at a company that practically defies the basic laws of traditional investing. We hear about them constantly, we watch their rockets launch, but behind the scenes, there's a massive, fierce debate raging among financial analysts. So let's crack this puzzle by looking at the hard data. Right out of the gate, we have to talk about this genuinely staggering number. We are looking at a massive company valuation exceeding $2 trillion. That is trillion with a T. And alongside that incredible figure, we see a share price sitting comfortably right around $171. Now, just to put that into perspective, a valuation of this magnitude places this aerospace giant in the absolute upper echelons of the most valuable companies on the planet. Naturally, when investors look at that $2 trillion market cap, it sparks a huge wave of intense scrutiny.
And that scrutiny leads us directly to the core puzzle we're going to solve today. How on earth can a money-losing company be worth so much? I mean, can a share price realistically hold its ground while traditional investors are basically screaming from the rooftops and tearing up their spreadsheets, arguing that it's completely overvalued? Whether you're an investor or just a student of the market, this is exactly the kind of paradox that forces us to rethink everything we know about how assets are actually priced.
Section 1. The Financial Reality, Examining the Clues.
To kick off our investigation, we really need to strip away the hype and just look at the cold, hard numbers. When we audit the key metrics, we see a stark, honestly unbelievable contrast. Revenue sits at $19.3 billion, showing massive top-line sales. But drop down just one line. Net income is negative $9.3 billion. They are bleeding cash almost as fast as they bring it in. And the valuation multiples? A price-to-earnings ratio of negative 68.5 and an enterprise value to EBITDA ratio of a whopping 643. To put that 643 into perspective, a healthy company in traditional finance usually sits around an EV to EBITDA ratio of 10 to 15. A multiple of 643 means you're paying an astronomical premium for a company that is deeply, deeply in the red.
And this brilliantly illustrates the paradox we're dealing with here. The valuation needle is basically broken off deep in the very expensive red zone. The company generates massive top-line revenue, sure, but it still loses money overall, pushing its valuation multiples to extremes that literally terrify traditional analysts. A price-to-book ratio of roughly 73, combined with that 643 EV to EBITDA, signals to any textbook investor that these shares are dangerously overpriced. By all traditional laws of financial gravity, this stock should be plummeting. So, why isn't it?
Section 2. The Missing Piece, Free Float.
To answer that, we actually have to ask a different question. What if the market isn't trading a $2 trillion company at all? Think about that for a second. If you look at the breakdown of total shares, the vast majority, around 95%, are completely locked up. They're held by Elon Musk, company employees, and early private investors who are just holding on to their equity. They are not selling. That leaves a measly 4 to 5% of shares that are actually part of the free float, meaning they're the only ones available for public buying and selling on the open market. This completely shifts our perspective, right? It forces us to ask a totally different question. What happens when millions of investors globally want to buy into a company, but there's only a tiny, tiny number of shares actually available to purchase? We aren't talking about a $2 trillion company being traded anymore. We're talking about a microscopic fraction of that being fought over by the entire world.
Section 3. The Scarcity Premium.
To really understand how this tiny, restricted supply impacts the market, let's look at some physical world mechanics. Think about Ferrari. Ferrari deliberately produces way fewer cars than they know their customers actually want because there's a limited supply, long waiting list form, people actively compete to get one, and because of that intense competition, Ferrari can charge incredibly high premium prices. The scarcity itself creates the value. Well, the exact same mechanism is happening with these shares. There is a severely limited supply of shares available to trade. Because of that, investors are forced into a bidding war for those few shares, which inevitably drives the price significantly higher than what traditional financial models would ever dictate. Scarcity doesn't just exist in physical products, it absolutely exists in shares too.
This brings us to what's known as the bottleneck effect. You've got massive market demand out there. ETF funds, huge pension funds, private wealth, everyday fans. They all have capital, and they all want a piece of the action. But all of that money has to squeeze through a very narrow gate, that 4 to 5% free float of available shares. When you have that much capital chasing that few shares, demand vastly exceeds supply, and the price just explodes. The price you're seeing isn't determined by the company's intrinsic value, it's determined by the sheer undeniable physics of supply and demand.
Section 4. Dueling mindsets. Two types of investors.
Because of this extreme bottleneck, we see a complete fracture in how people evaluate the exact same financial puzzle. Take Investor A. Investor A asks, what is this really worth? They're focused entirely on traditional fundamentals, trapped looking at that negative $9.3 billion net income and concluding, naturally, that the stock is a terrible buy. But then, consider Investor B. Investor B asks a wildly different question. How many shares are available and who wants to buy them? They focus on supply, demand, market behavior, and investor sentiment. They completely ignore the traditional math because they recognize the reality of the trading floor.
And this, right here, introduces us to the true power of market dynamics. Market dynamics are the powerful forces of supply, demand, and investor sentiment that can drive asset prices completely independently of traditional, fundamental business value. This is the ultimate key to our puzzle. It explains perfectly how an asset can be wildly, almost irredeemably overvalued on a piece of paper or a spreadsheet, yet be perfectly and rationally priced by the reality of the trading floor where real buyers and sellers actually meet.
Ultimately, the resolution to our big mystery is that neither Investor A nor Investor B is completely wrong. The most successful investors out there, they don't choose a side. They understand that the complete picture requires merging company fundamentals, knowing the actual value and the risks of those massive losses, with the psychological and structural reality of market dynamics. You literally have to understand both the spreadsheet and the bottleneck.
I want to leave you with a final thought today as we look at the sheer scale of what this company is building, reaching for the stars while grounded in these fascinating earthly economics. Knowing what you know now about the mechanics of the free float, the bottleneck effect, and the scarcity premium, if you expected strong demand and extremely limited supply, would you buy the shares even if they appeared wildly expensive? It's a question that reveals the vital difference between traditional valuation and actual market behavior. So how will you evaluate the next overpriced opportunity? Thanks so much for joining me on this explainer. I really hope it gave you a powerful new lens for looking at the markets.